Okay, today I'm gonna finish the corporate finance applications, and then I will talk about the final exam. So most likely this will be a very short lecture. Um, Remember that we have two major tasks in understanding corporate finance applications. The first is beta of risk asset, and the second is agency cost of debt. And we started this section beta of risky debt, and our major results are in this page. Right? So basically, you can see that um, beta of equity and beta of asset or unlevered beta, so they are related. And then you could also see that beta of debt is also related to beta of beta of debt is also related to the unlevered beta. So basically it means that beta E, beta U, and beta D, right? These quantities, they're actually interrelated. That is, if you give me beta E, I can find both beta U and beta D. So similarly, if you tell me beta U, I could tell you what is beta E and beta D. And you can also see that to do the calculation, we only need three additional components, right? We basically need delta, the market value of debt, and the market value of equity, right? So as long as you give me delta, D, and E, and then if you give me beta U, I can calculate both beta E and beta D, right? So that's the basic idea here. Of course, the major focus here is about application. And if you can understand these proofs here, that's great. But if you have any difficulty in understanding how exactly we can get these results, then that's fine. I mean, as long as you understand how to apply these formulas. Okay, now let's see this example here. So you would like to know the beta of debt for BB Industries. The value of BB's outstanding equity is $40 million, and we have estimated its beta to be 1.2. You cannot find the market data to estimate the beta of its debt. So you decide to use the Black-Scholes formula to find a approximate value for the debt beta. BB has 4-year zero coupon debt, and this debt has a face value of $100 million. And the market value of the debt is $75 million. BB pays no dividends and reinvests all of its earnings. The 4-year risk-free rate of interest is currently 5.13%. What is the beta of BB's debt? And so let's see what's the idea here. So the question is about beta D. And we know that if we have beta E or beta U, we can find out beta D, right? And you can see that we have beta E here, right? So we have beta E. Beta E is 1.2, right? So you can see that the idea is go from beta E, we can find beta U. And then go from beta U, we can find out beta D. And now you can see that we can apply these formulas, right? So basically you can see that from the first formula, we know that, I guess we should use the second formula. From the second formula, we know that if we have beta E, we can find out beta U. And you can see that we basically need delta D and E, right? So maybe let me write down the formula here. So it equals beta E divided by delta 1 plus D divided by E. And then after finding out beta u, we can use 1 minus delta and 1 plus EDE, beta E. So let's see what kind of data do we have here. So what you can see here is we obviously have D and E, right? So D would be $75 million, and E, which is the market value of equity, would be 40, right? So the only question is, how do we find out this delta here? Well, now we have to use the result we have obtained in the last chapter. That is, we should consider the firm's equity as a call option on the firm's asset. And this call option, we have learned, has an exercise price which is equal to the face value of the debt. So now we have to think about the valuation of a call here, right? So let's write down what is this call option. So this call option has an exercise price of $100 million because we know that the face value of the debt is $100 million. And then T, that is the day or how far the expiration date is. It is 4 years, right? Because we know that the expiration date of this call option should be the same as the maturity date of the debt. And we know that it's a 4-year zero coupon debt. So T equals 4. And we also know that sigma equals 25%. So this is a given number. And then remember to use Black-Scholes model. We have to find out 5 inputs, right? We have got 3. So we need risk-free rate. And we need so-called stock price. But here, we are dealing with the firm's asset. So the stock price in the Black-Scholes formula should be the firm's market value of asset, which would be D plus E. So it's 75 plus 40. It's 115. And we know that delta equals ND1, right? So the key here is to find out D1. And according to the Black-Scholes formula, D1 equals the logarithm of S divided by PVK times sigma. It's T. Right. I think I might be possible. I'm making some mistake. Oh, it's actually correct. Okay. Now, what is what is this S here? Well, it's 115. What is PVK? Well, PVK is the present value of the exercise price, and we know that K is $100 million. And then we have to discount it, and we know that this is a 4-year debt. So we would discount this with 1 plus the risk-free rate, and with the exponential of 4. So this should give us the number of 81. So 81.86. Right, so we have 81.86. And then this would be 25%, and square root of 4 would be 2. So plus 0.25. This would be, I don't know what's the number here, but it should be the same as this number giving the answer. And then we could solve delta, right? Delta would be ND1, which is given by 0.824. Again, this N is the cumulative distribution function for a standard normal distribution. Finally, after getting delta, and we have D and E, can finally solve beta U and beta D, right? So beta U equals beta E, which would be 1.2 divided by delta, and times 1 plus the ratio of debt and equity. In this case, it should be 75 divided by 40. So this will be 0.51. And then we can use the next formula to find out the beta of debt. So it's 1 minus delta and 1 plus the ratio of equity and debt times beta E, right? So again, use your calculator. You can find out the beta of debt, which is 0.14. So as I said, this problem has actually several caveats, right? First, you have to understand you can consider firm's equity as a call option on the firm's asset. And based on this, you will be able to use this Black-Scholes formula. So you could use Black-Scholes formula to find out ND1. Why do you want to find out ND1? Well, because this is your delta. So after finding out delta, you will be able to use the formula we just mentioned in the last page, right, to calculate beta D. And the process is, first you will go from beta E to beta U, and then you will go from beta U to beta D. And there is actually a simpler process. So let me show you here. So basically you can see that you can substitute beta U into the third formula, right? So it will become beta D equals 1 minus delta A divided by D beta U. So 1 minus delta A divided by D, and then beta U equals beta E delta and A divided by E. And then you can see that these two A's will just cancel out. So in the end, you will have 1 minus delta divided by delta times E divided by D and times beta E. So essentially, you can see that this is a more condensed process, right? So basically, if you give me beta E, and then if I have delta and the value of equity and debt, I can find out beta D. And you can verify that if you use this formula and if you plug in numbers we have here, then you will get the same result, that is 0.14. Okay. Next, we talk about the agency costs of debt. So remember, this is a very important topic in the capital structure chapter, right? So this is a part of this so-called trade-off theory. That is, if the firm has a lot of debt, then there are some agency costs. There are major types. The first type of the agency cost is called asset substitution. It basically means that even this project is a negative NPV project, but if this project has this excessive risk, then equity holders will want to pursue it. And you can see that pursuing this negative NPV excessively risky project will actually hurt debt holders. And then we also talk about we also talk about debt overhand, right? In that chapter, debt overhand basically means if the firm has default risk, then equity holders, sometimes they will pass those positive NPV projects. So they will not offer investments for these positive NPV projects. So which means these positive NPV projects will get wasted. So this will not be helpful to the firm or to debt holders. And we can understand these two kinds of agency costs using option theory. So first, why do we have asset substitution? Well, this is because we know that equity can be considered as a call option on the firm's asset. And then we also know that from Black-Scholes model, the value of a call option is larger if volatility is larger. I think I actually forgot to mention this important result. So in this formula, a very famous result is if this volatility increases, then the value of call will be larger. Okay, so let me go back to this. So here you can see that because equity can be considered as a call option, and the call option is more valuable if volatility is higher. This essentially means that equity holders, they will want to increase the firm's volatility, which means equity holders will want to take excessive risk, because taking excessive risk increases the firm's risk, which means the firm's volatility should be larger, right? And according to the option theory, the call option value will be higher. That is, equity's value will be higher. And then we could also talk about debt overhang. To understand this, we should see that, again, equity is a call option on the firm's asset, which means the value of equity can be decomposed into two components, right? We can use the firm's asset and a risk-free bond to replicate firm's equity. Here I am actually talking about the binomial pricing model, because we learned in binomial pricing model, if we have a call option, this call option can be replicated by a stock and a risk-free bond. And for equity, its underlying asset is the firm's asset. So a firm's equity can be decomposed into the firm's asset and a risk-free bond. That is, the value of equity can be replicated by a portfolio of the firm's asset and the risk-free bond. And then we again have this delta here. And we know that from the Black-Scholes model, delta equals ND1, which is always smaller than 1, right? So the implication of this is so we can see something like this. Let's say asset equals 10. And now asset increases to 11. Let's assume delta is 0.5, right? So what you can see here is if delta is 0.5, then equity's value will increase by 0.5. So you can see that for $1 increase in the firm's asset, the gain to the equity holders will be smaller than 1. So this essentially means this will reduce these equity holders' incentive to invest in the firm, and it will lead to underinvestment, right? Because it's like, hey, if I increase the firm's value by 1, I only get 0.5. So most of the time, I won't want to make any investment. Okay, now let's look at this example here. So suppose BB Industries, so it's the same firm we just discussed. So suppose BB Industries can embark on a risky strategy that would increase the volatility of its assets from 25% to 35%, show that shareholders benefit from this risky strategy even if it has a negative NPV of minus $5 million. Alternatively, suppose BB tries to raise $100,000 from shareholders to invest in a new positive NPV project, which does not change the firm's risk. So what minimum NPV is required for this investment to benefit shareholders? Okay, for the first one. So now investors are pursuing a strategy which has a negative NPV of minus 5. So supposedly this should reduce equity's value, right? However, it increases the firm's volatility. And we understand the firm's equity can be considered as a call option on the firm's asset. So if the firm's asset has a larger volatility, then the call option will be more valuable and equity will be more valuable. So that's the basic idea here. So let's see how can we do the calculation and show that shareholders will actually benefit from this kind of risky strategy. Okay. So basically we will think about option valuation. And you can see that here we have volatility, which is 35%, and we still have the same risk-free rate and same T, which is 4. What else? So we have 3 inputs, and we need additional 2 inputs. Oh, we have the exercise price, right? So exercise price is still the same. That is the firm's debt face value, which is $100 million. I think it's $100 million. And now, what is S here? So previously, S is given by 75. Oops. Is given by $75 million of debt. Oops. So it's given by $75 million of debt and $40 million of equity. But now because of this NPV project, so the value of the firm decreases by $5 million. So we have to use a minus 5 here. This would give us 110. So basically you can see that we now have all 5 inputs. So we can now value the firm's equity, right? So remember that now it equals S times ND1 minus PVK times ND2. And then you will basically repeat the same process we have done before when we were using Black-Scholes model. So you can see that D1 would be given by the logarithm of S divided by PVK. Oh boy. And sigma T plus sigma T2. And D2 would be, I think it's D1 minus sigma. I could be wrong, so let me check what is the formula for D2. Okay, yeah. Let me see. Oh, actually, the formula for D2 is actually correct here. So you can see that we pretty much have all these inputs. So we can just plug in numbers. And then I will just copy the lecture note. So in the end, the value of E is $42.5 million. So I would suggest you to actually put in these numbers and verify that you will actually get a market value of equity as $42.5 million. So what you can see here is after this risky negative NPV project, the firm's equity increases from 40 to $42.5 million. So of course shareholders will be happy to pursue this negative NPV project. Now why do we have a result like this? Well, there are basically two offsetting forces here, right? First, this project is a negative NPV project. So this will push the value of equity down. However, the negative NPV project has a larger volatility. So this will push up the value of equity. And in this specific case, the force of volatility is larger, or the effect of volatility outweighs the effect of the negative NPV. So in the end, the value of equity actually increases. So you can see that this is actually a very neat way to calculate how asset substitution will affect equity holders and how asset substitution will affect the investment of the firm. Okay, now let's look at the second one. So second one says, alternatively, suppose this BB Industries tries to raise $100,000 from shareholders to invest in a new positive NPV project. And now what is the minimum NPV is required for this investment to benefit shareholders? Okay, think about this. We know that equity can be written like this. So A refers to the firm's asset, A delta plus B, which is a risk-free bond. Again, I'm just assuming I am replicating the value of equity with firm's asset and a risk-free bond B. And in this case, what you can see here is, so now let's say the firm raises so $100,000, and then you can see that after this project, the firm's value would be the amount raised plus plus net present value, right? So what's the benefit to shareholders? Well, the benefit is essentially the increase in the value of equity. So it's E prime minus EE. And you can see that this should give us 100,000 plus NPV times delta. So you can see that for the shareholders to be willing to invest in this project, this benefit has to be larger than the cost, right? So if you focus on this inequality here, we will be able to solve the minimum NPV, right? So essentially minimum NPV has to be larger than $100,000 divided by delta minus $100,000, right? So what is delta here? Well, we calculated in the previous example. Delta is 0.824. So we could plug in numbers, 0.824. This should give you a number which is 210. 21875. One comment is you can see that my solution here is actually slightly different from the lecture note, but in the end they're actually the same. It's possible that if you use this formula here, your number could be different. Maybe it's 215 something or 216 something due to rounding error. Okay, let's review the chapter questions. What is the key assumption of binomial option pricing model? So the key assumption here is you will assume that the stock's future prices have only two values. So in the lecture note, we have today's price as 50 and tomorrow's it's either 60 or 40. What are the key assumptions of the Black-Scholes option pricing model? I don't think we actually talked about this. If you go to a more advanced class, which teaches about how to derive Black-Scholes option pricing model, then you will actually learn those key assumptions. So I guess the lecture note wants you to understand the Black-Scholes option pricing model we learned here can only be applied to non-dividend paying European call options. But I have to say this kind of knowledge, this question here is not super important in the in this class because we're only focusing on the corporate finance applications. What is the implied? I don't think I have talked about implied volatility. So let's remove this one. What are risk neutral probabilities and how do they relate it to valuing options? So risk neutral probability is a fictional or adjusted probabilities which is consistent with risk-free rate as a discount factor. The reason is in the discounted cash flow analysis, if cash flows have risk, then the more conventional approach is we adjust that discount factor, right? We add a risk premium to the risk-free rate. And we use this adjusted discount factor to discount risky flows. But here, right, we will continue to use the risk-free rate as the discount factor. And instead, we will adjust probabilities. So these adjusted probabilities are called risk-neutral probabilities. You're using the word risk-neutral because this probability is solved in a risk-neutral world. Why it is a risk-neutral world? Well, because you're discounting everything with the risk-free rate. And in terms of how to use risk-neutral probabilities to value options, it is enough if you could understand our lecture note. So basically, you will first use the price of the stock to find out the risk-neutral probabilities. Because if you discount because if you discount the stock's expected payoff with risk-free rate, you will be able to find out its risk-neutral probability. And then you will use this risk-neutral probabilities to calculate the expected payoff for this option. And then you will discount this expected payoff with the risk-free rate. So this will give you the correct price of your call option. How is the beta of the call option related to the beta of the underlying stock? Well, the key here is you will want to consider the call as an option. Sorry. The key here is you want to consider this call option as a portfolio, right? That is, the call option can be replicated by a portfolio of call and risk-free bond. And in this case, you can basically think, okay, if the call has two components, that is share and bond, Then this is a portfolio. So this portfolio's beta would be the portfolio weight of the stock times its beta, right? Of course, the portfolio weight of debt times the beta of debt. However, in the replicating portfolio, we assume we're only dealing with risk-free rate, right? We're only dealing with risk-free bond. So the beta D here should be just 0. And then you can see that this is how the beta of call and beta of the underlying stock are related. How can one estimate the beta of debt? So we have a series of equations. Oops. Oh boy. So we have several formulas, right? So basically you can see that go from beta U, you can get beta E, or go from beta E, you can get beta U. So if you want to find out beta D, then you could go from beta E to beta U, and then beta U to beta D. Or you could use this formula I wrote here. That is, you could directly go from beta E to beta D, as long as you can find out the delta